just kids when we fell in love, not knowing what it was. I will not give you up this time.
Good day! You're entering the world of retail math. So today, the first thing that I will discuss are the markups and markdowns. Markups. Markup is the difference between what a product costs you, the retailer, and what you sell it for to a customer. It is also known as gross margin and gross profit in a financial statement. The formula in finding markup is simply selling price minus cost. On the other hand, markdowns are reductions from the original selling price.
So first, markup. What is markup? Markup. Markup is an amount added to the price of something, while markdown is to put the price at the lowest.
So, dito naman tayo sa differentiate markup from margins. So, the margin is the gross profit ratio or the gross margin ratio expresses the gross profit or gross margin amount as a percentage of sales. Markup is used several ways. Some retailers use markup to mean the difference between the product cost and its selling price. So, markup versus margin. Formula. Markup is equal to profit divide cost. Margin is equal to profit divide retail price. So let's assume that the cost is 5 pesos and the retail price is 9 pesos. Let's go first to markup. Markup is equal to profit divide cost, which is profit is equal to 4 and divide 5, the cost, is equal to 0.8 or 80%. And then the margin is equal to profit divide retail price, which is 4 divide the retail price, 9, is equal to 0.44 or 44%.
Gross profit or gross margin. The gross profit or gross margin is a baseline profitability ratio measurement against total sales revenue. The gross profit margin is the percentage of total sales revenue that remains after deducting direct production-related costs. The formula for calculating gross profit or margin is simply total sales revenue minus production cost over total sales revenue. The resulting number is then expressed as a percentage.
So how to compute for single trade discount? First, we have to find the given. The given in the problem, which is first the 3,000 pesos, which is the list price. The list price is the original price. Next is the 20%, which is the discount rate. So the missing is the net price. We have to find the net price. Before we find the net price, we have to get first the trade discount. Trade discount. So what is the formula for trade discount? TD is equals to list price times discount rate. So our list price is 3,000 pesos times the discount rate. Now the discount rate is 20% and we have to convert it to decimal, which gives 0.20. So the answer is 600. So this is the trade discount. So now that we found already the trade discount, we can now get the net price. Net price is equals to list price minus the trade discount. So the list price is 3,000 pesos. And the trade discount is 600. And the answer is 2,400. This is the net price, the discounted amount. So the next is how to compute for discount series. So first we have to find the given again. So what are the given? The given are this price again, which is 6,000 pesos. And the discount rate is equals to 5. Next is step 2. In step 2, we multiply them together to get the net price equivalent rate. So, yun. Net price equivalent rate equals to discount 1 times discount 2. Yun. So, 90. Since we will multiply them, we have to convert it to decimal. 0.95 times 0.90 makes 0.855. So, the rule is do not round off decimal. So, this is the net price equivalent. So, yun. We have step 3, in which we will compute the net price. So, net price equals to list price times net price equivalent rate. So, yun. Since LP is equals to 6,000 pesos times the net price equivalent rate, which is 0.855. That makes it 5,130 pesos. That is the net price. That's the net price.
Dito naman tayo sa difference between profit and loss. So, profit and loss is a summary account used at the end of an accounting period to collect the balances of the nominal accounts so that the net profit or loss may be shown. So, the profit is the advantage or benefit that is gained from doing something. Sa makatuwid, ang profit, ito yung kabuoang kinita mo sa isang negosyo. Loss is the money that is spent and that is more than the amount earned or received. Or
Profit. When it comes to running a business, profit is the king. Profit is the amount of money a business makes during a given accounting period. It is defined as total revenue minus total expenses. Generally, the more profit you make, the better, as profit can be reinvested into the business or retained by the business owners. Being able to accurately determine your business profit is an essential part of being able to judge its financial health. It can also help you decide how to price your goods and services, how to pay your employees, and more.
So, break even. Break even is when you don't make profit and you don't lose money either. So, in break even, it's like you just get back your capital.
How is interest calculated for a mortgage? Each month, you make payments on your new mortgage. A portion of the payment goes to paying down your balance or principal, while the other portion pays your interest charge. The proportion of your payment that pays interest versus principal changes every month. Mortgage amortization. Mortgage amortization is a method of reducing an installment loan debt until it reaches zero. When you establish a mortgage account, the lender determines your interest cost based on an amortization schedule. It takes into account both payments toward the loan balance and payments of interest. Calculation. The way the mortgage company calculates your interest is pretty straightforward. You can do this by multiplying the balance by the monthly interest rate.
So we have different types of commission. Number one is straight commission. Straight commission. So straight commission. Straight commission is a salesperson compensation method in which only a percentage of sales volume but no fixed salary is paid. The amount received by a salesperson is a function of his or her performance reflected in sales volume. Next is number 2, salary plus commission. So, salary plus commission is one of the more common compensation structure used by employers to pay salesmen. Employees receive a guaranteed base salary amount but also earn an undefined amount of commission based on the amount of sales they make. So, quota. The third is the graduated commission. Graduated commission. Graduated commission is a system of compensation for salespeople where the percentage of sales earned increase incrementally as sales volume increases. A graduated commission structure might be used by a business in order to provide sales staff of commission with a greater incentive to increase sales volume.
So, dito naman tayo sa commissions on cash basis and commission on installment basis. So, ano nga ba ang commission on cash basis? Commission on cash basis refers to major accounting method that recognize revenues and expenses at the time physical cash is actually received or paid out. And then, the commission on installment basis, when a seller allows the customer to pay for the sale over multiple years. The transaction is frequently accounted for by the seller is using the installment method. Because of the long period of time involved, the risk of loss from customer non-payment is higher. So a prudent person will defer the recognition of some portion of the sale, which is what the installment method does.
Payment cost. Down payment cost is a number derived from the purchase price. If you buy the house for $600,000, the required minimum down payment is a percentage of that price. For example, if you qualify for a 3% down payment, the down payment you will owe at closing is $18,000. A down payment of 5% is $30,000, a 10% down payment is $60,000, and a 20% down payment is $120,000. As you can see, lower down payments make home ownership more accessible to people who have limited savings and don't have another property to transfer equity from. That's down payment cost.
So our problem is, Bea has a debt of 20K with 10% interest yearly. So how can we find the interest? The formula for interest is principal times rate times time. So the principal is 20,000, which is the main debt. and the rate is 10%, in which we will be converting in decimal, times the time, which is yearly. So 12 over 12, which makes 1. So 20,000 times 10 times 1 is equals to 2,000. That is our interest.
Well, maybe I came on too strong. Maybe I waited too long. Maybe I played my cards wrong. Oh, just a little bit wrong. Oh, baby, I apologize for it. I could fall or I could fly here in your aeroplane, and I could live, I could die hanging on the words you say. And I've been known to give my all and jumping in harder than 10,000 rocks on the lake. So don't call me baby unless you mean it, and don't tell me you need me if you don't believe it. So let me know the truth before I dive right into you. You're a mystery. I've traveled the world and there's no